Have you ever stared at a stock market screen, seen tickers like SPY or QQQ, and wondered, what exactly are those things? These symbols represent something called an ETF, or exchange-traded fund. And while they might seem mysterious, let's peel back that layer to see just how these investment vehicles work. Imagine you have a basket of different toys, some plush animals, some building blocks, and some small cars. Now, what if someone created a magical toy box that could automatically replace any broken or missing items in your collection with new ones? That's kind of like an ETF. It's a collection of assets like stocks, bonds, or commodities. They're bundled together into one convenient package. And here's the surprising part. Just like how you can shake up a magical toy box and pull out different toys without knowing exactly what will come next, you could buy shares in an ETF and not know exactly which underlying assets make it up. But that uncertainty is balanced by the fact that these funds are designed to track a specific index or basket of stocks. ETFs are bought and sold on stock exchanges just like individual company stocks. When you see SPY on your screen, you're looking at a fund that tracks the S&P 500 index. This means it's essentially holding a small piece of nearly every large U.S. company listed in that index. So if tech stocks or energy companies are doing well, SPY might go up in value. Okay, so now we're getting into the heart of what makes an ETF tick. Let's talk about that index. Think of an index like a big basket full of different stocks. Just like how you might have a fruit basket with apples, bananas, and oranges, an index is made up of various stocks, maybe Apple, Microsoft, Amazon, and more. So, how does this basket stay so precise? Imagine you're on the playground playing ring toss. Each stock in the index acts like one of those rings. The ETF is constantly watching to make sure all these rings are still in the right spots. In other words, if Apple's price goes up or down, the ETF has a mechanism to adjust its holdings accordingly. And here's the surprising part. Even though there are many stocks, it's not like trying to count every single ring on your own. The people who manage the ETF use computer algorithms and fancy math to keep track of everything. Think of it as having a really good assistant who updates the basket in real time, keeping all the rings, stocks, in the correct positions. This is why when you buy an ETF, you're essentially buying a piece of this diverse basket of stocks. It's like diversifying your own portfolio, but with less hassle. You don't have to worry about picking individual stocks or constantly rebalancing because the ETF does it for you. So you got stocks chopped up into tiny pieces, right? Now imagine those pieces as ingredients in a bustling kitchen, where chefs are constantly chopping and mixing them to create all sorts of dishes. An ETF is like the recipe that tells the chef how to make a delicious, consistent dish every time. Imagine you have an ETF tracking the S&P 500. The market is like a big kitchen filled with hundreds of cooks, traders, chopping up stocks, ingredients. Now, think about a master chef who has to keep everyone in line, making sure each piece of the recipe gets mixed just right at the right moment. Here's how it works. Every day, when the market opens for business, the ETF manager is like the head chef. They have a set list of stocks that make up the S&P 500, the recipe. Their job is to keep an eye on all those chefs chopping away and make sure each ingredient gets added to the mix at just the right time. Let's say you own a slice of this ETF. You get a piece of each stock, but it's not as simple as just holding one stock. The market is dynamic. Stocks go up and down, so the value of your slice changes too. But don't worry. The head chef, ETF manager, makes sure that every time someone buys or sells from you, they're given a piece that matches the recipe exactly. And here's the surprising part. To make this happen in real time, the ETF manager doesn't actually own all those stocks. They have a clever system where they can trade small portions of each stock quickly and efficiently. This way, every time there's a change in the market, their slices are adjusted to stay true to the recipe. So whether it's morning or night, the market is always bustling, with chefs adding and removing ingredients. But you're safe because your ETF is like a magical kitchen that keeps everything in perfect balance. And here's the surprising part. Behind the scenes in the world of ETFs, there are these magical ingredients called creation units. Think of them like special recipes that allow for large-scale baking. Now, imagine you're a baker who needs to make a huge batch of cookies. Instead of mixing just one cookie at a time, You have a secret recipe that lets you churn out thousands in one go. That's kind of what creation units do, but with ETFs. Creation units are essentially large bundles of the underlying assets within an ETF. They're like the secret recipes for baking those big batches. When someone wants to create a new bundle of ETFs or take one apart, they use these creation units. For instance, if you wanted to make a new batch of a popular ETF that tracks the S&P 500, you wouldn't just buy individual stocks and blend them together. Instead, you'd work with a group called an authorized participant, AP. These APs are like professional bakers who have access to all the ingredients needed. When it comes time to create the ETF, these APs gather enough of the underlying assets, like shares of those 500 big companies, to form one massive bundle. This bundle is a creation unit. Once they've gathered everything, they take this bundle to the exchange and trade it for newly minted ETF shares. It's like swapping your raw ingredients directly for finished cookies. The APs get the new ETF shares, and voila! A large batch of ETFs has been created without having to buy or sell every single underlying asset individually. But why do they bother with all this? Well, by using these creation units, the process is much more efficient. It's a bit like batching your baking instead of making one cookie at a time. This makes trading smoother and faster for everyone involved. So, next time you see an ETF being created or taken apart, remember it's just a fancy way of large-scale baking. Using these special creation units to keep everything running smoothly behind the scenes. Alright, so far you've learned about creation units and how they're like the magic ingredients that bake an ETF. Now let's dive into the detailed steps of how an ETF actually works behind the scenes. Imagine an orchestra conducting a symphony. Every musician has their part to play. In our case, it's every player in the ETF ecosystem. First up, the ETF is just waiting there, like a conductor standing at center stage, ready for orders. When you, or any investor, place an order to buy or sell ETF shares on the stock exchange, this is where the magic starts. The stock exchange acts as the referee, making sure all transactions are fair and square. And here's the surprising part. When it comes to buying large chunks of ETFs, things get a bit more interesting. If you're looking to purchase or redeem creation units directly with the issuer, which is often an investment firm, they step in like a maestro conducting the whole process. They can actually create or redeem these large blocks of shares on their own, provided there's enough demand from investors. Now, let's talk about the secondary market, where most ETF transactions happen. Think of it as the bustling backstage area where every instrument has its moment to shine. Once an investor buys or sells a share in this market, the fund doesn't need to create or redeem anything directly. Instead, the shares are simply transferred from one investor to another. But here's where things get really interesting. All these buy and sell orders create what we call the order book. It's like a big choreographed dance, with every order trying to find its perfect match in the secondary market. The order book shows the current demand and supply of ETF shares, with bids at one end and asks at the other. And you might be wondering, how does all this maintain accuracy? Well, it's all about the NAV, net asset value, calculation. Think of the NAV as the orchestra tuning their instruments before performance. Every investor needs to know the exact value of an ETF share. The issuer calculates the NAV based on the underlying assets in the ETF basket and updates it regularly. So, that's the secret recipe for how an ETF works. It's all about orchestration, creating large blocks when needed, conducting trades through the secondary market, and ensuring accuracy with regular NAV calculations. Just like a symphony, every part is crucial to make everything run smoothly. Alright, so by now you know how an ETF works, like a magical recipe that combines a bunch of ingredients into one tasty package. Each ticker can include dozens or even hundreds of different stocks, bonds, or commodities. But here's the final insider secret. Understanding this is crucial for your investment journey. Think about it like this. When you invest in an ETF, you're not just buying a single stock, you're buying a slice of the market itself. It's like investing in a whole bunch of companies through one convenient wrapper. This means that ETFs are incredibly diverse and can spread out your risk across many assets. Imagine you have a basket full of apples, bananas, and oranges. Each fruit represents different stocks or bonds. If an apple goes bad, it doesn't ruin the whole basket. Similarly, if one stock in the ETF underperforms, it won't necessarily drag down your entire investment. That's why experts say ETFs are great for diversification. Diversity reduces risk. Another secret is that when you buy an ETF, you're not just buying shares. You're also getting access to something called the index. The index is like a map that tells you which companies or assets the ETF includes. This means you can easily follow what's happening in the market without having to do all the research yourself. Understanding this helps you make smarter decisions. You can choose an ETF based on its underlying index, such as the S&P 500 or Dow Jones Industrial Average, and feel confident that you're investing in a well-known benchmark. Plus, knowing how diversified your investments are can help manage expectations and reduce anxiety. ETFs also use advanced technology to keep track of all these assets in real time. They use something called an order book, which is like a big spreadsheet where orders come and go, just like passengers boarding a plane. This constant updating ensures that the ETF's value stays close to its net asset value. By understanding how ETFs work, you're getting one step closer to decoding the market. It's like knowing the code behind your favorite video game. Once you get it, everything makes a lot more sense and feels less mysterious.